So getting into our presentation today. So in this 1 hour presentation, Russell, Melanie, and Ankit will be sharing their insights on the following topics as it applies to divorce and business valuations. What is a business valuation? When would a valuation be required? Types of valuations and reports, costs, benefits, the risks and pitfalls. How can two experts come up with different values? What assumptions are most likely to be attacked, and different interpretations? Why does the court like hot tubbing so much? And top tips for business owners, spouses, and lawyers. As always, we will save some time for a Q&A segment at the end of the presentation. So please feel free to send in your questions via the Q&A box. And as always, the chat function is disabled, you'll notice. But like I said, you can send those in through the Q&A. We just want to make sure everyone stays anonymous to others for this presentation. And we just ask again that everyone keeps in mind this content is intended to provide general information on this topic and should not be considered as legal advice. And just to note that this program, as well as our last 3 presentations of the day, have been accredited by the LSO for 1 hour of professionalism content. So you could submit your CPD hours through the LSO portal with them. Without further ado, it's now my pleasure to reintroduce Melanie. Melanie is the founder of Calyx Valuations Incorporated, and throughout her professional career, she has been involved in many assignments for a variety of public and private companies of various sizes and across many industries. Melanie obtained her training at 2 of the largest international accounting firms in the industry, and she placed second in Canada on the CICBV membership examination. Ms. Russell has been active in teaching business valuations and related topics at various universities and professional organizations, and runs the premier preparatory course for CBV students in Canada taking their national membership qualification examination. She has written various articles, taught professional courses, and had many public speaking engagements on matters relating to business valuations and related topics. Melanie has qualified as an expert in the areas of business asset valuation, quantification of damages, income determination, and forensic accounting. She has testified as an expert in business valuations in the Ontario Court of Justice and the Ontario Superior Court, and for the Investment Dealers Association and the Discipline Committee of the Institute of Chartered Professional Accountants of Ontario, as well as in alternative dispute forums. Next, we have Ankit, who is a partner at Valuation Support Partners Limited and has over 17 years of professional services firm experience. He provides business valuation and litigation support services to law firms, private and public companies, as well as individuals. Services include rendering of conclusions of value of business, intellectual property, and economic damages. He has completed numerous valuations and expert reports for various purposes, including matrimonial disputes, collaborative family law, commercial and shareholder disputes, breach of contract, share transactions, tax planning, corporate reorganization, succession planning, bank lending, and financial reporting. Ankit has participated as an expert in business valuations and income assessment at mediation, settlement conferences, and collaborative meetings for matrimonial separations. Next, we have Russell, and Russell is the founder and senior partner of Russell Alexander Collaborative Family Lawyers. With over 20 years of experience, Russell offers a wealth of knowledge and expertise in collaborative family law. He uses his experience with a client-focused approach by creating unique solutions for each of his clients to enable them and their families to move forward. And so those are our presenters today. For our next presentation, I'm going to pass things over to Russell to get started.
Thank you, Shannon. Excellent as always. Let's throw our poll up there and get right at it. Few reminders. Please send in your questions through the Q&A box. We're going to answer as many as we can throughout the program. Please give us your feedback, obviously. We have these polls that we're going to do. We have a new audience today, so we're going to run this last poll. I have a suspicion what the results are going to be, but let's see what the audience says, and then please participate in the polls throughout. Helps us make it a little bit more interactive. We did have a question come in right through the gate since we started up this session. How do you handle a spouse removing records from a company, such as credit card statements? And how do you handle a spouse writing down inventory to reduce income? So we've got 2 issues there. Removing the records and writing down inventory. Who wants to take a crack at one or both of those. Ankit?
I can probably start, and Melanie can pitch in more. So in terms of removing credit card records, typically if they've been run through the business and they've been expensed, they would probably leave a trail on the general ledgers of the company. So it would be worthwhile to understand if the general ledgers are there and the amount of detail which is there. Having said that, a disclosure can be requested to have the credit card statements produced. So that is on that piece.
Have
Talking about
them
inventory,
reissued, right? Yeah, that makes sense.
yes, having them reissued. Yes.
Yeah,
yes.
okay.
So that was on the first piece. On the second piece of having inventory written down, now that can be a very big and challenging area to function on, because was the inventory required to be written down, and how has the inventory been disposed of which has been written on? So if it was, yes, sir, Russell.
Okay. Thoughts on the inventory question, Melanie?
Yeah, I'll just comment on that. What you've got to remember with inventories, if you write it down in 1 year, maybe that affects income, but it reverses it entirely the next year. So if you're properly double entry bookkeeping, it affects 1 year, but it'll reverse the next year. So if you're looking at a longer period of time, it should have less of an impact than in one particular year, but in one particular year, it could have a big impact.
All right, good to know. Thank you. Great question. Please send in your questions if you have more. And law professional, 80%. So fairly sophisticated crowd today. Other professional, 7%. And the balance is pretty much the same as what we've been seeing all day. So thank you, everybody, for participating in that poll question. All right, what's a business valuation? What are we talking about here, Melanie?
Well, a valuation is basically trying to figure out what someone else would pay for it under perfect market situations. So valuators are trying to guess at what someone would offer for a particular asset, whether it's a property, a real estate property, whether it's a business, whether it is a financial instrument like an option. So any asset and even a liability, evaluators put numbers on it. And we use a little box called value premise. And typically although family law uses value, it doesn't give you a value premise. We typically start with something called fair market value. And that is what two parties would agree, and those two parties being independent, they negotiate at arm's length. They have full information, not perfect information, but full information at a particular date and in cash. So we typically put this perfect market scenario around the situation that doesn't ever actually happen, but we're trying to price an asset based on those circumstances. So a business valuation report will talk about what we've done, what the circumstances are, what the nature of the asset is, and what we've done to come up with the value. And typically what we look at when we're putting in our little fair market value box is what the future cash flows are expected to be, how risky those future cash flows are going to be. So what kind of rate of return would an investor require on that asset? And what does the balance sheet look like, or what do the hard assets look like that are underlining the particular asset?
Thank you so much. Ankit, you want to add to that before we go to our next poll? Or we could throw our next poll up and you can give us your comments on Melanie's.
Sure. So yes, I think the definition of fair market value is very important. So yes, I'd go with that part, fair market value.
All right, poll number 2. Have you ever had a business valuation or worked with a business valuator? So we're going to give that a moment for our audience to answer. It's not quite a binary choice, but I had an interesting question that came in. Thank you for submitting it. And I think our next topic will answer it, and I do have some comments about it. How much should a business be worth in order to do a valuation? What if a party thinks it's worth less than the cost of a valuation? So just kind of hold that in abeyance. We're going to get to that in the next slide, but let's see what our audience thinks. And 40% has had experience with the CBV. 49% no, but I know someone that has. So surprisingly, maybe it's just the nature of the practice, but not everybody's been in contact with the CBV, and or maybe they haven't had a reason to. So when would a valuation be required? This kind of ties into that question the audience member sent in. And please keep sending us your questions. Ankit, what do you think?
Sure. So definitely, we're talking about business valuation. So we're talking about matrimonial divorce matters here. Definitely, that is required for a matrimonial purpose. Typically, the business is one of the properties of the business owner, and that needs to go on the net family property statement for equalization purposes. That is why we have a business valuation of the owner's share interest. Besides that, the other reasons why a business valuation is required, there would be an actual transaction involving the business. There's actually a potential buyer or a seller for the particular business. And then it may be required for planning purposes, say for tax planning, for estate planning, for exit or pre-sale planning purposes of the business. Then definitely it can be looked at for value enhancement in terms of trying to understand how the value of the business can be increased, focusing on the key value drivers of the business, and then timing the exit or the sale of the business. And definitely for litigation purposes, whenever there is a commercial or a shareholder dispute. So definitely that is in addition to the matrimonial matters here.
I assume it could be also useful if you're trying to get financing, right? To buy a business. That would be a useful tool. So going back to that question, I've had a case where my client was a tradesperson. He was the business. He had a van of tools, no inventory. And we spent there was a court order for the valuation, which I thought was a bad idea, and I think the valuation came in to be about $12,000 or $15,000 to produce it for a van full of used tools, which wasn't worth much more. So I guess you need to have some common sense. What are we valuating and how much is it going to cost? But what are your comments in terms of when would a valuation be required, Melanie?
Yeah, I would say common sense. It's a great one. But one of the things I wanted to just point out is that, in a matrimonial situation or family law, you may have a number of reasons. One of them, exactly as Ankit was saying, value it in a separation to equalize the property. But you may also have jointly owned property, jointly owned business, where the valuation date may not be much of an issue. It's a current date. So there may actually be a commercial, like an actual transaction going to be taking place, or someone hopes it's going to take place. Two parties have to agree to it. That blows it outside of the separation date. So if you've got a company that's owned 50-50 by husband and wife or the two spouses, it really doesn't matter what the separation date values are. It only matters what the current date, if the two are going to agree to transact and one party buy out, which is a whole other set of issues.
Yeah, great point. Let's throw up our next poll. I suppose another reason for counsel to get a valuation done, if you're unsure, you have a duty to get proper disclosure and to provide proper advice to your client. So 5 years down the road, if somebody's kicking the tires at the separation agreement and may imply that your lawyer didn't do his or her job or didn't do their due diligence, you'll have a business valuation that you can rely on, produced by an expert saying this is the information we used and it was accepted by the parties. So if you're unsure and it's a huge asset or if it's a significant business, it might be better to err on the side of caution and paper your file. And you can even attach the valuation as a schedule to the separation agreement, so everybody knows what was looked at during the negotiations. So next poll, for those who have had worked with a business valuator, what was the primary purpose or reason? Matrimonial home, tax, estate, succession planning, actual transaction, purchase, sale, shareholder buyout, or other. So let's see what our audience thinks of this poll question. Collaborative mediation, litigation, 80%. Some tax and estate succession planning, 18%. Actual purchase, 7%, and other. You can put the other in the Q&A box and we'll be able to tell. So thank you. It looks like clearly a family-focused crowd today in terms of business valuations. So let's get to our next topic. Types of valuations and report. So Ankit, you want to tell us what's available for people going through a separation and the lawyers? What type of report should we be considering?
Definitely. I think one needs to understand the complexities in the business and the amount of depth required. So to start with, written reports are categorized into 3 categories. One is a comprehensive valuation report, which is pretty extensive in its research and it corroborates a lot of evidence. The next level, which is a one step down, is an estimate valuation report, which has a minimal review, limited corroboration. And the third step or the third level is the calculation valuation report. It has very limited information. It has limited review. And so that is calculation. And in the same order, it all depends on how much information we request. It depends on the kinds of reports. So those are the kinds of reports. Going further ahead, once a report is prepared, there is also a limited critique report, which is actually a critique of the valuation report produced by another expert. So one can be asked to prepare a limited critique report. Bear in mind that report would not bear a conclusion of value. So if a valuation needs to be reperformed by the other side, they would probably need to engage to do a full-blown valuation report again. And the third and not commonly used and should be taken with caution is a verbal report. It is just an analysis which is presented verbally without supporting documentation. So it is advisable to have people who have sophistication or understanding of valuation listen through the verbal report to make it meaningful for the parties and make it cost effective.
So let me ask a question for the oral reports or the verbal reports. Why are you saying we should be cautious of those? Because I'm thinking of my clients, right? They're going to say, I don't want to spend a lot of money. Just give us a number, right? I don't need a written report. We're not going in court. But why should we be cautious about those kinds of reports?
That's a very important point you bring up, because what happens is the valuation is based on an understanding of the business and understanding of the risk factors of the business. And then based on that, certain assumptions are taken. Now, those are very well laid out in a written report, and a potential client can refer to them again and again. But when we are doing a verbal presentation, if there is a sophisticated audience to understand it, it helps to then go through the verbal presentation, and so that they can absorb it. And if a party has an advisor or an external party whom they want to refer to, those people can absorb it probably. So it helps to have people well prepared to listen in for the verbal reports to make it meaningful. And it all depends on the level of complexity again. So if a person has basic financial knowledge and is able to grasp the matters, because one needs to go much more beyond just the conclusion number. One needs to understand the assumptions, because ultimately that value is going to be put on an NFP statement for equalization purposes. And then the other party may be challenging it. So one needs to be well prepared to understand how are they going to defend those numbers, or how are they going to present that value to the other party should they require it.
Great. Thoughts on the types of reports, Melanie? You want to add to this?
Yeah, for sure. I think it's it's an important issue. And just, interesting, it's only Canada that has three different levels of assurance. And the CICBV, or the CBV Institute, is actually looking at whether they've got an exposure draft out, and they were going to squash those because they're trying to move towards the international valuation standards. But I think they've decided to keep them because they're so ingrained in what we do. So, but it is important for clients to understand what's involved in each of them. And my experience is that clients usually want to default to the cheapest one. No surprise. But the standards for us as valuators mean that regardless of what we conclude, we have to be comfortable with that. So even if we do the lowest level, doesn't mean that if we don't come across something, we pretend it's not there and ignore it. We still have to do the appropriate work on it. In terms of the oral reports, I think that's to me, it's a very dangerous area. And where I've had success, where I think it's worked, is where it's a very simple business. And it's like your business, your client's business, the one van and the tools. And then you can educate the clients to say, here's how a evaluator would look at a situation like this. How can there be a lot of intangible value or goodwill or client relationships? It's kind of like a self-employed individual contractor. My experience with the oral reports is sometimes they work, but often it's exactly as Ankit said, that there are different parties who they have different levels of financial expertise. They may have outside advisors, the Greek chorus, as some people would call it. And it's very hard to go to that Greek chorus and say, well, Melanie or Ankit told me that the value is 1 million. And they'll say, well, how the heck could it be 1 million? And they have no idea. And I've had situations in collaborative even with financially sophisticated parties, where they've said, we only want the oral report. And then they've ended up at the end, okay, I think we've got to change this to written report. So I think you've got to be careful with those.
Yeah, I've had some success with oral reports in a collaborative setting. But there are risks. You're right. People may hear things differently, right? Well, that's not what you told me, or that's not what you said. And as counsel, you may want to paper your file, right? You don't want a law pro claim coming back 4 or 5 years later because somebody misheard it, or you're right, the Greek chorus gets people riled up and starts saying there was a bad deal. Or maybe 4 or 5 years later, the company's worth a different number, and there could be an explanation for that. But one person might think, oh, well, it's always worth that. So yeah, I could see a lot of pitfalls there, but this kind of ties in neatly with our next topic of costs. So, Ankit, what should we be looking at in terms of costs of these reports? I suppose oral, and I could be wrong, might be the least expensive because it's less work, but you tell us.
Sure. So I'll come to that part of the question. I'll just give a brief fundamental overview before I address the critical point which you're talking about. So the business interest, it can be a single business, it can be multiple businesses, and then it can be in particular one geography, it can be in different geographies spread out. One industry, different industries. So basically, there are different complexities which one needs to understand. And then we need to understand whether these are operational businesses or are these holding companies. So typically a holding company would be more economical, less time consuming. So it would be more economical to do them. Operating businesses, they would take more time to do. And then depending on the level of analysis which has been requested by the parties or counsel in terms of, say, it's a calculation or they require more corroboration, we need to get to an estimate level, or there are many interested parties in it, we need to get to a comprehensive. So depending on that, the cost can vary. So let's say, simply put, I would just speak for what I have noticed around, typically in the market. It's one company, one operating company. We're just doing a particular, say, calculation report. Cost would be, say, between 5,000 to 7,000, just a ballpark, just for understanding. Coming to the question which you said about Russell, verbal, would it be cost effective or not? The answer can be a yes and a no. So it all depends that if the parties have trust and they're willing to go with the verbal answer and go ahead with it, definitely it's going to be more economical going for a verbal. But should one actually pose additional questions or require further analysis, and then a written report is required, so if that is going to go a step ahead, it may actually end up being a little more costly than just a regular written report. So it all depends on the particular situation, is what I would actually mention on that.
That's the lawyer answer. It depends, right? Melanie, what do you think of costs? What, you have any input here?
Yeah, I agree. Of course, it always depends. And it depends almost in a lot of the similar factors we talked about on the income side, is that if you're working on a joint retainer, then in theory, things should go a little smoother because you should, at least on the information or the documentation collection. But then you've got two bosses, plus never mind the lawyers are also your bosses, but the two parties are your bosses. So they'll want input and you've got to deal with the communication, et cetera. The more complicated situations, as Ankit said, the more complicated, if you look at the org structure, that's going to be a lot more, that if you're having difficulty, if you're working for one party that has terrible books and records, or their accountants are involved in tax season and they're just not communicating with you, or sometimes I've sometimes had clients who don't have good resources, like they don't have a good internal or external accountant or bookkeeper, and because they want to save money, so they're trying to be the ones that provide you with all the information and compile it, but that takes a long time and they may not really understand what you're asking for. You have to go back a few times and queries. So lots of different possible webs of the way engagements can go, which affects both the costs and of course and the timing.
That ties in neatly with the benefits though, right? Usually there's a benefit associated, and that's our next subject. So maybe you can start us off on the benefits of business valuation, Melanie.
Sure. The benefits are that you can hopefully get a number. You have something to put onto your NFP, and hopefully a few numbers are covered. The asset value, any amounts owing to or from any shareholders, any contingent disposition costs. So hopefully you've got a few of them covered. So you get numbers to plug in, and that can hopefully start your negotiations or start the process. It's also, taking it outside of matrimony, it's also good for a business owner to understand what they have and or what they don't have, and be realistic about what they built up. It can also help them, with projecting out in a separation what income might be and how their lifestyle might work, and for both parties, that what is this company all about, what's its cash flow generating possibility. So a lot of benefits. It can also help figuring out, on a practical level, if there's ways to improve the value of the business and do things to make it, to help improve those cash flows and improve the value of it.
Yeah, and I guess if the business owner is getting remarried, he'll have an accurate number for his date of marriage deduction, right?
Exactly. He better do it really quickly, because you don't have to argue about a year difference. So do it like within a month or
you gotta think
so.
outside of the box. And we're starting to see things stabilize a little bit, because at the beginning of the pandemic, a lot of our cases we just kind of put on hold, right? We didn't know how the pandemic was going to affect this business. Is next year going to be like the previous year? But we're seeing a little bit more certainty, a little bit more consistency moving forward. Do you want to add to the benefits, Ankit? Or let's throw our poll question up, but any other benefits that you want to contribute?
Right. So it gets a whole structure in place, and I think it adds to time efficiency. So doing it early on in the process is definitely helpful.
Right. All right, so let's see what our audience is thinking. We haven't gone to our audience, so thank you everybody for participating in our polls. In your experience, what's the most contentious valuation issue you've had to address or deal with? We're going to give everybody a moment to answer that poll question. We had some questions coming in online. Thank you again. Put your questions in the Q&A. We're going to try to answer as many as we can. Can you compel a company's accountant auditor to communicate openly with the valuator? All right, I know I have an idea about this, but Ankit, can you go first? Have you had that problem?
Yes. So one can request because ultimately the parties are not reporting to us, the accountants or the auditors. So we can request them, and then they would have a duty to be open and unbiased and provide what is required. So I would not say that we would totally compel them. We can request them again or ask more questions which take a further deep dive.
You mean a duty? They have their own rules of professional conduct for accountants,
Yes.
and that includes timely response. Melanie, any thoughts on this question?
Yeah, I would say it's a bit of a sticky issue for accountants because they have to look at who their client is and what what their obligations are from a confidentiality point of view. So they have to.
There could be other shareholders, right?
There could be other shareholders.
Maybe a minority investor in this company, and you're going through a divorce.
Exactly. So sometimes you don't get a response from them because they get stuck, or they have to consult with CPA Ontario or whatever the provincial group is, or they have to consult with a lawyer and other shareholders and just make sure that they're not crossing any lines before they can get back to the, and I find once they get approval, they usually are quite happy to speak to the valuators, but they need to make sure they're protected themselves.
And like the income assessments, you need to be mindful of seasonality, right? This is a difficult question in a collaborative setting. And we talked a little bit about this in our last presentation. But I've found case management judges in the Superior Court to be very willing to make orders, even sometimes not on notice. They are making this order, and if the person objects, they can come back and we'll have a full hearing. Requiring third parties to produce information because it's grinding the case down. Just like it's slowing the collaborative process down, it's also slowing the court process down. So usually judges are, especially if you give notice, will likely make the order because they need the disclosure to properly adjudicate the case. So great question. Thank you for sending that in. Let's see what our audience thinks. All right, so most contentious issue or valuation, unreported cash is the leader at 36%, 24% personal expenses, 19% income diversion, 15% unreasonable expectations, impact of COVID, 3% thus diminished, and other. This is similar to what the responses we got on the income side, right? There seems to be certain themes that we're consistently seeing, whether it's income or the value of the business. Would you guys agree with that?
Yeah, I think there are a few more though.
Okay. Well, let's get into our next topic because, all right, well, what are the few more? So let me cut you off.
No, that's okay, because I don't want to jump ahead.
No.
Are we okay? Do you want to? Okay.
Yeah, we've got time.
So we've got some weird issues, not weird issues, but different issues with valuations over income. And for example, you get this concept of a multiple. What's the multiple, the capitalization rate, the discount rate? That sometimes can be contentious.
I assume there's industry standards for certain businesses in terms of multiples, or is there still a lot of discretion there?
There's a lot of judgment. It's because what you have to remember with evaluation is it's all forward looking.
And can you explain to our audience what a multiple is?
Oh, sure. So if you think of real estate's an easy way to look at it. So you buy an income producing property that's generating $100,000 a year, and they talk about a cap rate. So if the cap rate's 5%, the multiple is the inverse of that. It'd be 1 over 5%, so 20 times. So if it's generating 100,000 a year, and you multiply that by 20, and that's presumably the value, $2 million. So it's really the cap rate or the inverse, which is a multiple, is just what, in theory, someone would pay for an entity. So if the business entity is earning $1 million a year, and someone says that the multiple is 5, then the value of the business is $5 million, 1 million times the 5. So it's sort of it's a summation of the rate of return and the risk associated with the business.
Obviously, even a small change in the multiple is going to create a huge difference in the value.
It for sure can. And I guess one of the other areas that's somewhat subjective, or it can be is definitely different than in an income analysis, is a redundant asset or liability.
All right, so explain again for our audience what that means in case they don't know.
Yeah, why would you know, right? I don't think there's anything in law school that teaches you what a redundant asset is. So the idea of a redundant asset is it's just a non-operational asset. So very simple example, you've got two businesses that are earning the exact same cash flows, exact same risk profile, exact same customer, everything's exactly the same, but one of them owns a business and one of them owns their property and one of them doesn't. Or one of them has paid out all of their earnings as dividends, and one of them has kept it all as retained earnings, which does come up in income analysis. That company that has that extra asset in there is more valuable because it has that asset. So you pay something for that extra redundant non-operational asset.
Excellent. All right. The more I learn, the more I get worried that I'm overlooking something every time we have these discussions. So risk and pitfalls. Melanie, you want to start this one off?
Sure. The risks and pitfalls of not getting a valuation or not getting the right valuation?
Both.
Okay.
Right.
Yeah. So I guess not getting a valuation is an issue of not getting the right number. So either putting too high or too low onto for equalization purposes. The risk of not getting the valuation that is sufficiently reliable or has enough diligence, or maybe has the right expert who knows the industry or knows how to do valuations, is again, you'll get the wrong answer. Someone gets the wrong solution in terms of an equalization payment, or it creates a lot of professional fees, a lot of dispute, and not an easy resolution. So one of the benefits of a good valuation is that it may help to resolve the case.
Right. Do you want to add anything to this, Ankit?
Yes, definitely. I'd say good record keeping helps in better analysis. So if it is well presented, historical financial statements are consistently classified, it helps in a better understanding for the reader. Yes. Russell,
Sorry, yeah. Let's talk about our next slide. How can two experts come up with different values? And I think...
Has that ever happened? Has that ever happened? I've never seen that.
Well, then we can move on to the next topic. That's why, of course, that's what happens, because that's why we have a room full of lawyers online trying to figure out what's gone wrong with their reports. So, all right, we're going to give this one to Ankit. You want to lead in and get Melanie's take?
So taking the last poll question on and taking on the additional inputs which Melanie was giving, talking about multiples, you can very well see that, in valuation, there is a mathematical side and there is a conceptual side and there is a proper valuation methodology which is being used. And at the same time, there is an understanding of the business. So there's a different understanding which different valuators may have. There may be different assumptions which the valuators may be privy of. So essentially what we're saying is, because of these difference in understanding, the adjustments and the understanding of the risk can be different. So that would probably take me to Melanie's first point about the multiple, where the multiple can vary because there is a bit of judgment. Having said that, I would say that what is also required to be understood is the research, which particular industry this particular company is in, what are the recent transactions which are there, which geography those transactions are in, are they similar in size, those companies which are being compared. So are we comparing apples and apples, oranges with apples? So it's very critical to understand what are we comparing with, and why is the value coming to be different.
So what I hear you saying is business evaluators are artists, right? There's a art and science to all this. Melanie, what's your take on how can experts come up with different numbers?
Yeah, it gets exactly right. I think, and I learned this pretty early on, that just because someone says something doesn't mean it's right. There's usually more than one viewpoint. So sometimes it's an issue of getting different information, different viewpoints, because a lot of the valuation is art or subjective, because we're projecting into the future and we're trying to guess at what someone would pay without having someone writing a check. And if you think about what evaluator is actually trying to do, we're doing some level of diligence, right? We come in, so we're kind of mimicking the purchase and sale situation, but on a very limited basis. And obviously, the higher the report assurance you're providing, the more diligence you're providing. But we're only doing part of the diligence. So if someone was actually looking at buying this company that we're valuing at that date, they would be doing a ton of diligence, and they would be peeling off many, many, many layers of the onion. And from a cost and timing perspective, valuators aren't doing that. And so we're not going to find all the warts or all the good stuff. So I think it's different information, different levels of research, different, sometimes we're told a different story and someone else has different information that contradicts that.
Yeah, I'm thinking, these venture capitalists, they do 6 months of due diligence and something happens, they pull the plug and walk away. You're going through the divorce, you can't pull the plug, you still need to come up with a number, right? So this sort of leads us neatly into our next slide. What assumptions are likely to be attacked or take different interpretations? You talked a little bit about it with respect to the multiple. Ankit, what other assumptions? I guess opposing counsel, either through cross-examination or questions to the evaluator. Are there certain themes that we see that are usually most likely to be attacked by the other person or their lawyer or their expert if they don't like the report?
Yes, typically what we've noticed is that, in matrimonial matters specifically, when we're trying to normalize income. So if you're using, say, an income-based valuation approach, and we're using a particular method and we're trying to normalize the earnings. Now, in the normalization, we are, say, normalizing and probably removing discretionary expenses or personal expenses, or we are adding back certain amount of additional income, which is obviously based on certain inputs. Now, those can be subject to inputs from the spouse, and that may cause a difference. So those assumptions can have an impact on the earnings level. And going back to Melanie's point, supposedly it is the real estate business of, say, 100,000, and there is additional income which needs to be reported there, which makes it go by even up, say, 10%. So now the 10 into multiple of, say, 20 is straight away 200,000 there. So it can cause a change in the conclusions. And an understanding of the risk factors is another point where we notice that the multiples are different. So that does cause a particular difference in the conclusions, which gets attacked. And then we're talking about the normalized working capital level or the current ratios. So we're typically trying to use industry benchmarks. But a unique, small businesses are unique to an extent that they have their own advantages, which may not line up with the industry. So there can be a difference in thought process of excess cash or redundant assets, which Melanie was mentioning about, working capital injection being required because probably the company is working below the working capital level. So there's additional money which needs to be put in, which may be treated as a debt-like. So it depends how it is viewed and what is more realistic for the particular business. So there are these assumptions which can be attacked.
I suppose there's lots of businesses that don't have an industry standard either, right? Or a reference point. So that could be a source of a different interpretation. Melanie, what are the hot button assumptions that you're seeing being attacked?
Yeah, in addition to Ankit went through quite a few good ones. One that is I see a very common is the level of market remuneration. So in evaluation, as Ankit said, what we do is we take we're ultimately trying to predict the future. Often there aren't projections, or if there are, we test them with the historical results, and we normalize the historical results for certain things. And one is, in an owner-manager private company situation, they may take a lot of benefits out. They may take whatever remuneration they want that year, or they may take dividends. They may pay their spouses. We talked about the income splitting before. So one of the things we always do is add back those related party transactions, what are actually recorded in the company, and then we normalize them as if a third party had bought the company. What would they be paying those related parties? So add back for the spouse, the kids, the parents, the cousins, the aunts, the uncles, all the personal expenses, the owner, him or herself. And then we say, okay, now what is a fair remuneration? What would that position generate if on a third party owner? And if you talk, of course, to the owner, who obviously generally will want bias to reduce the value of the company, and also probably or may overstate their value to the company, you're going to get a lot lower value than if you possibly, if you speak to someone else and say, no, we could replace that person with half of what they're paying right now. So I think that that I find is one of the extreme. There's a lot of variables and assumptions that are sensitive in evaluation. That in an owner managed situation often is one of the bigger ones.
All right, great to be mindful of those. Thank you. So let's go into our final poll question of the day. We've got a couple more topics and we're going to get into Q&A, so we're right on time. What happens when two experts disagree as to the value of a business? So you've got some options here. I'm going to go to the Q&A and give everybody a minute to put their answer in. One question, could you bring a motion to request information from a third party records? Yes, put the third party on notice and give them an opportunity to respond. I like this one. Is there a scenario, I like them all, but this one kind of caught my eye. And please put your questions in because we've got Q&A coming up. Is there a scenario where there is a combined income assessment and business valuation? So I guess you're going for the deluxe package there. How often do you do that, Melanie, the combined reports?
All the time, like the income and the valuation?
Well, it makes sense, right? You're digging into it anyway, right?
Yep. And sometimes we get situations where one of them is delayed. Maybe we're not getting the more current tax returns because they haven't been filed or the accountant's busy. So we may then separate it, but it is usually more efficient to do them together, I find, because you're not writing backgrounds and a lot of the same stuff in both reports.
I find it quite common, especially in family run businesses, because there's so much usually expense and personal items going through the business. Sometimes there's cash. You're trying to value the business, so kind of makes sense to peel one onion instead of two, right? If you're going to be doing it, and they're quite common. Ankit, has this been your experience as well?
Yes, definitely. Most of the time, it makes it efficient to do it together. Unless, say, we're doing a couple of years ahead of the valuation or separation date, we're doing income assessment, and data for that is required. So then, at that point in time, that may be done a bit separately. But for the common years, which are being analyzed, yes, it makes sense to do it together.
Right. And I think we want to keep in mind the valuation date, right? If you're doing it pursuant to the Family Law Act. Income assessments might, as we said in the last presentation, you might look at 3 or 4 years. Or we could be, there could be an explanation for a bump in the incomes as well. So you might be looking at multiple days. Let's see what our audience thinks about experts disagreeing. take the highest value, take the lowest value, use the average of the two values, 40%. Try a dartboard. Nobody tried that one. Or let the court decide. Yeah, I can't, you decide, right? So actually, that kind of leads us into our next topic, which is Melanie's and hot tubbing. And who would ever think experts like the hot tub, but judges are always throwing them in there. So what are we talking about when we hear the court or a judge say, get you two experts the hot tub?
Well, I think it's a very unfortunate selection of terms, but it does create a lot of fodder for jokes between the experts. And always visualizing, would I really want to get in the hot tub with this expert? Ankit, okay, but anyone else? Not sure. So
I guess you gotta pick. You can't pick your opposing expert, right? Not all the time.
Exactly. I think obviously the court likes hot tubbing a lot because they're delegating that decision to experts, which in some ways, the idea is use an expert to help them come to a decision. And then if you have two warring experts, then is that really help? It's not as helpful, obviously, as if they could come to their own decision. So I think it's sort of the down or delegating that decision. And it doesn't, but often in my experience, it often doesn't necessarily resolve all the issues, but it may narrow them. And it definitely makes sure that both experts have the same information, because sometimes you get to the point and you go, oh, I did not see that document. Nobody provided it. I did not realize that. So that may help to narrow. But it also flushes out, even if you can't get to one number, it flushes out what the issues are. So it's much easier for the courts and lawyers to say, Melanie says this, Ankit says this. There's good reasons for it, or it's a legal issue, or whatever it is. But now we know what the differences are, so we can focus on those differences and see if we can deal with them legal. If it's a legal issue or otherwise.
Well, you think about it, depending on the asset, right? The judge might be looking at a 15-day trial with limited court time and a backed up docket. There could be 10 issues in play, and they tell the experts to go hot tub or discuss those issues. You might get it down to 2 or 3 issues, right?
Mm-hmm.
And
exactly.
The experts agree on the remaining 8. So now your 15-day trial is down to a 5-day trial. And you probably have saved the parties maybe $100,000 in legal fees, probably more. So, there's some real value to having the experts talk about what the differences are and why. And sometimes even report back to the court, this is what expert A thinks, this is what expert B thinks, this is the rationale. And it really helps the judge to get an understanding as to what's going on. Ankit, any input on this topic?
Yes, definitely. It is an efficient concept, provided, we don't have two leading guns supporting their sides. They're open and willing to understand what the thoughts are. So rationally, they are able to work in an independent and unbiased manner. It can help narrow down issues.
Yeah, and if the same experts go back to the trial judge and say we're still at 10 issues, it's not going to go well for the experts, right, if they're not cooperating with the direction from the court. And I think a judge would start to lose patience with them if they're just, it's a battle of the swords kind of thing. All right, so let's get into our final topic. Then we're going to go to Q&A and wrap up this 2-day summit. This has been a fantastic subject matter to wrap up on, because there's so many things to consider. And like Melanie said, a lot of lawyers aren't taught these concepts in law school. And unless you know to identify these issues or to look for them, you may not be asking the right questions. So, top tips for business owners, spouses, and lawyers. So, why don't we start with Ankit this time, and we'll finish with Melanie.
Okay, so before engaging, I'd say there should be an understanding of the level of report they intend to have. So basically have an action plan before engaging the particular valuator, and talk about, like we're talking about combined income valuation reports, trying to understand if it requires both parties need to retain the same valuator, having one expert, or both parties retaining different experts. I think that is helpful. Having good organized records, being organized, having them handy, or providing them in a time efficient manner can help in cost efficiency through the process. Being open and honest and transparent, it just helps so that a single valuator or different valuators are coming to somewhat similar or conclusions within a particular range, so to say, and providing a timely response that helps immensely flush out the process faster for us.
Melanie, you want to wrap this
Sure.
up and tell us?
Sure, I'll
some
wrap it
tips?
up.
Well, no,
So-
you got a couple minutes here. I just want to get your
Oh.
tips.
Okay, so I'd say for everybody, make sure you read the valuator's report. I mean, Ankit talked about making sure you know what you're getting into to begin with. You got to think about it and make sure you read it. And maybe you also get a valuator to help you read it, to interpret it.
How
Unless
many,
you
how many
everyone
people
understands.
how many people don't read the report? Is this a problem?
They just go, "Where's the number? Where's
They
the
go
number?
right to the
What
last page or the second page or whatever the number falls on.
conclusion?"
Yeah. It's usually it's around page 3, right, of a 10-page report. Okay.
Yep, jump over to that. So, and yes, and maybe get some involved, because I know if I'm going to read a case or a legal document, it's always nice if I can call up a lawyer and say, okay, what does this mean? So if you have an expert evaluator to help you out, that's great. Look at the underlying assumptions and look at the scope. Once you get a report, look at the scope of review that's in there. So what was looked at? What were the underlying assumptions? Because that can give you clues to how much was done and whether anything might have been missed. And look for this is for everybody, and this actually is more for evaluators, is looking for other value metrics. Don't ignore them. So if there have been offers, if there have been transactions, if there's a shareholders agreement that talks about a formula, if there has been a reorganization, there may have been other valuations done. So don't ignore those other metrics. And they sometimes may be more realistic than trying to create a valuation at the valuation date.
I think my tip would be ask if there was previous draft reports delivered and ask for copies of those drafts and try to get an understanding of how the final report deviated from the earlier drafts, if it did at all. And that's going to be a source of a lot of questions, right? Well, why did that deviate? Who did you talk to? What influenced your decision to change your initial conclusion? Lots to pursue there. Thank you both so much. And look at who's back right on time. Shanna, our DJ, is back in the house. Welcome back, Shannon.
Thank you. Thank you to our experts again for the great presentation, back-to-back presentations. We really appreciate it. And thank you again, everyone who has sent in questions. We have another moment or so here just to go over the last few. So question I have here is, can the opposing parties use and agree to use the same evaluator?
Thoughts, Melanie?
Yeah,
I
of
guess,
course.
I guess the question is, can two people use the same person?
Yeah, it's probably more of a legal question, but of course.
Yeah.
Of course.
You want a process in place where the lawyers agree on which one it's going to be, right? You don't want to just jump on board unless there's been some diligence, and you want to make sure the person's not somehow interested or biased in who's preparing the report. Great question, though.
I'm going to do one more here.
Sure.
We have, can economic recessions or crisis affect valuation?
Yeah, we kind of touched upon that with COVID. Ankit, any thoughts on that one?
Yes. So typically companies or industries have a particular economic cycle. So they may have been doing good before the recession and or the particular COVID crisis. And then during COVID, they've done better. Or at times things have not turned out in their favor and they've gone the other way. So yes, I think what is important is the valuation date or the separation date in matrimonial matters. So that date, and we need to consider factors up to that date. So that is why it is very important to understand when did COVID start, when was the separation date. and how does that need to be considered at all?
Great answer. Shannon, it's time.
It's time. That brings us to the end of the day, the end of our Family Law Now Live Summit. I just want to thank Melanie and Ankit again. It was an honor and a pleasure having you as part of this event. So thank you very much. And thank you again to all of our audience for joining for this presentation. And those of you who also joined for other sessions, we really hope that you have found it informative. Again, if you have the time, we welcome and appreciate any feedback you have. And also feel free to leave us a review on Google to share your thoughts. We really appreciate it.
Thank you, Ankit. Thank you, Melanie. Enjoy the rest of your holiday. Shannon, fantastic work for over the last 2 days and 2 months putting this together. Thank you so much.
Thank you.
Thanks,
Bye,
Shannon.
everyone.
Thanks, Russ.
Thank you.
Bye, everyone.
And thanks to our audience. Have a great afternoon or good evening.